Well, good afternoon, everybody, and thanks for taking time out in these very difficult times we're all experiencing. I noticed by the numbers that we've got a lot of smaller shareholders as well as institutional investors and analysts, so welcome to everybody, particularly to our smaller shareholders. And on that note, I'm very pleased to be able to report to you all that both companies have been able to increase their dividends slightly for you this morning. So my name is Rob Milner and I'm Chairman of Brickworks and Washington H. Soul Pattinson. And with me today I have Lindsay Partridge, the Managing Director of Brickworks, and the financial man from Brickworks, Robert Blakewell, and our Managing Director at Soul Pattinson, Todd Barlow, and his financial guru, David Gribben. So as I mentioned, we've been able to increase our dividend in these very difficult times. And generally speaking, in these difficult times, these two very good sound companies tend to outperform, which I think you've all seen in the last month or 6 weeks.
Well, thanks very much, Lindsay, and good afternoon, ladies and gentlemen. Just while our slides are loading up, actually there they are. I'd like to start with just a brief overview of our business. We always do. We have a diversified portfolio, and I hope to cover off on why we believe that diversification is very important and has been very beneficial to shareholders. We've got a broad mandate to invest across a range of asset classes, and I think that's important, particularly in times like these. We were able to shift our focus in recent times when prices were high. We bought more private equity, provided more direct credit, and invested in counter-cyclical hard assets like agriculture. In this market dislocation, our long-term approach means that we can hunt for mispriced companies with solid fundamental businesses where we can take a long-term view. Having a value-based approach to investing has been tough in recent years. The market has been extremely strong, but hopefully we can execute well now that the market has presented the value investor with more opportunities. I hope to cover our approach to capital preservation with defensive businesses which generate strong cash flows so we can continue to pay stable and growing dividends to our shareholders. I'll start with a look at the company performance through the first half of FY20, which is the period ended 31 January. The group regular profit for the half was $124.7 million, down 33% on the first half of FY19. Regular profit is more relevant because it removes one-off gains and losses, and in the first half of FY19 we sold the head office building in Pitt Street, which generated a significant profit. That led statutory profit in first half of FY20 to be down 71%. We don't believe that profit is a good indicator of our success. You can see in the history of profits by half over the past 5 years in this chart, profit has grown overall, and the first half 20 profit was higher than the second half of 19. Profits were obviously higher in the middle there in 2017, 2018 when thermal coal prices were very high. But what we focus on is the same thing that many investors focus on when they consider their portfolio. Firstly, we aim to grow the value of the capital, and during the half we achieved a very modest gain of 0.2%. And secondly, we aim to improve the yield we receive, and we measure this by looking at the cash that we receive from our investments, and this was up 0.7% for the half. Cash generation was very strong in FY19 and increased 18% on the previous year. Today, WHSP has declared an interim fully franked dividend of 25 cents per share, and the record date will be 23 April with payments due on 14 May. This is the 22nd consecutive increase to our interim dividend. And over the past 20 years, the interim dividend has grown at a 9% compound annual growth rate. As I mentioned earlier, through the half, the net asset value of the portfolio was essentially flat, and we finished the half at just under $5.5 billion of assets pre-tax. Increases in TPG and Brickworks through the half were largely offset by a decrease in the value of New Hope. The only major investment we made was the agriculture investment in the private equity portfolio. And we've taken on more bank debt to fund recent acquisitions in agriculture, and we have more capacity to make further acquisitions if future opportunities arise. This table shows the total shareholder returns for WHSP shareholders for various periods and compares them to the ASX All Ordinaries Accumulation Index. WHSP is focused on long-term growth. The TSR performance has been strong over the period shown above, with the exception of the last 12 months. Short-term TSR can be significantly or is significantly impacted by share price volatility. At this time last year, we were reporting a one-year TSR of 56.5% for the 12 months to 31 January 2019, whereas the one-year TSR to 31 January this year is negative 16%, reversing some of the strong share price gains that we saw in 2018, I should say. However, if you look at even the last 2 years, there's been an outperformance despite WHSP being positioned defensively in a very strong growth market. We've always looked at longer term performance, and our aim is to outperform over the long term. You can see here that over 20 years, WHSP has a total shareholder return of 13.2% per annum, which is 4.6% higher than the index. And the compound benefit of this outperformance can be seen in the graph, where over 20 years, a 20-year period, an investment in WHSP has grown over 11 times, while an investment in the index has grown by just 4.2 times. During the half, we deployed capital into the agriculture sector. We've acquired a high-quality, diversified portfolio of land and water-based agricultural assets across Australia. The portfolio produces a range of commodities, including citrus, macadamias and cotton, all of which are commodities where Australia has a global competitive advantage, stemming from its low cost of production, high product quality and ability to deliver counter-seasonal production. The portfolio is in the process of a comprehensive redevelopment plan, which is expected to result in a material lift in productivity, profitability and value. The other event of note, which the Chairman mentioned earlier during the half, was that we welcomed over 5,000 new shareholders, which was a 25% increase in total shareholder numbers. Shareholder numbers have more than doubled over the last 5 years. Of course, there's been major impacts to global markets and the economy since the end of our half in 31 January. I'll provide a brief update on how WHSP is performing since half year end, and when I discuss each of the portfolio investments, I'll also address how they are faring in light of the new business conditions we're experiencing. Since the start of the second half FY20 on the 1st of February this year, WHSP's share price has been quite resilient. As at close of business yesterday, WHSP was down 10.6%, while the All Ordinaries Index was down 29.7%. We believe our company is in good shape to weather the storm. We have a diversified portfolio of good quality assets, many of which are very defensive in nature. And it's interesting to look back in history, and over the last 20 years, last 20 of our financial years ending 31 July 2019, the All Ordinaries Index had been negative just 3 of those 20-year periods. However, in each of those years where the market was negative, WHSP's total shareholder return was actually positive in all 3 periods. The recent events are making forecasting extremely difficult, but we do have good line of sight on the cash that we will receive in this financial year. The majority of our cash in the FY20 year is comprised of the FY19 final dividend and the FY20 interim dividend from our major investments. TPG has declared a 3 cents per share dividend, which is up 50% on the previous year. Brickworks has today declared a 20 cent per share dividend, which is up 5%. And New Hope's 6 cent per share dividend is 25% below the FY19 number. However, based on the dividends declared from our major investments, we believe that this year's cash generation will be in line with last year, which I should note was up 18% on the previous year. And this will support our ability to maintain or better previous dividends. Our focus during this time is in ensuring our business is well managed through the crisis. We're deeply focused on protecting our employees and protecting the wealth of our shareholders. These events are unprecedented and causing massive disruption to business models and the broader economy. Every business will be impacted. We believe that our portfolio of quality businesses generating real cash flows should be resilient, but we're working very hard to manage our portfolio through this. We have available liquidity to take advantage of new opportunities, but we will be cautious. It's a time of great opportunity, but it's also a time of great risk. Looking now at the components of our portfolio and starting with our largest investment, TPG, which reported in its first half 20 results that its revenue was in line with the previous half and its business as usual EBITDA was down just 5%. TPG's business as usual earnings strip out the costs of the aborted Australian mobile network costs as well as the costs of the Singapore rollout. And you can see from the chart on the right that TPG continues to lose margin as customers migrate from TPG-owned infrastructure to the NBN. However, TPG is offsetting most of the NBN headwinds with growth in other earnings, which are primarily as a result of earnings growth in the corporate division, general overhead reductions, and earnings from their Tech2 business. And most of the migration from TPG infrastructure to the NBN has now played out. The large majority of TPG's customers are now on NBN, so future margin compression should not be as significant. The big news, of course, is that the recent federal court decision has allowed the merger with Vodafone to proceed. This was very welcome news, though frustrating that the uncertainty effectively caused an 18-month delay. We now expect the merger to be implemented in July this year. Vodafone and TPG together will be a very strong company in the telecommunications industry. They each bring a network of owned infrastructure which will be highly complementary to the other. The company should be able to achieve significant synergies and be in a very good position to win market share from the larger two operators in the industry. Before the merger, TPG is expected to make a special cash dividend to its shareholders, as well as the spin-off of the Singapore mobile network, the Singapore mobile business. We're also expecting an increase in the ordinary dividends of the business going forward. TPG should not be impacted significantly by the COVID crisis or the follow-on economic slump. Telecommunications is a consumer staple, and if anything, we should see increased demand for the value-focused offerings of TPG and Vodafone. And since the 1st of February, TPG's share price is down 7% compared to the market, down 30%. I can skip through Brickworks because you've just heard from Lindsay, but I did want to mention this slide in particular from Lindsay's presentation reflects how we think about Brickworks. Just 28% of the portfolio is exposed to building products, and that is split geographically across Australia and North America. It also holds a diversity of products. But the real diversification comes from the fact that property investments are almost as big as the building products business and should not only continue to perform during any downturn, but should benefit from further cap rate compression. And 50% of the portfolio is in WHSP's business, which I've tried to outline today, is defensive in nature. So when I look at Brickworks' share price and how it's performed relative to the All Ords and relative to other listed business building products businesses, it's no surprise that it has outperformed during this market turmoil. But given 72% of its investments are in WHSP and industrial properties, I would have expected the market to give greater recognition to this fact. Nevertheless, it has performed significantly better than its peers, which have all underperformed the market, some by a very wide margin. New Hope released its results this week. Revenue was in line with the first half of FY2019, despite coal prices being on average 29% lower than those experienced in the first half of FY2019. The price reduction was offset by increased ownership of Bengalla and increased production at Bengalla. That price reduction, however, had an impact on profit, and regular EBITDA was down 25%. New Hope continues to deliver strong operating cash flows and announced a 6 cents per share fully franked interim dividend. Since listing in 2003, New Hope has paid over $2.4 billion in dividends to shareholders. New Hope is still waiting for approvals for its New Auckland Stage 3 extension. Unfortunately, people who object to the mine continue to engage in lawfare and hold up the process. New Hope has satisfied every technical requirement and succeeded at every decision-making level. We hope that in short time the government's ability to delay the final decision will be exhausted. The demand for electricity is relatively stable and growing in our region, along with population growth, urbanisation and economic development. In the 5 years to 2024, it is forecast that global electricity consumption will grow by 12%, and most of that growth is coming from Southeast Asian, South Asia and China. It's also true that renewables and other forms of electricity generation will generate some of the growth. However, 64% of this growth in electricity consumption in South Asia and Southeast Asia is expected to come from new coal generation. This is against a backdrop where we see limited new supply of thermal coal, particularly the good quality, lower emission coal that many customers are now demanding. Recent events relating to the spread of COVID-19 and the sharp drop in oil prices have not had any immediate impacts for the demand for coal. In fact, demand is holding up quite well, and the thermal coal price in Australian dollar terms has risen over 10% since 1st of February. Factories are already returning to production in China, and in time the rest of the world will be back online. It should be noted that following the GFC, when the global economy contracted around 1.7%, thermal coal had one of its best years. The recent collapse in oil prices can be both a positive and a negative for New Hope. Falling oil prices are helpful to reduce the cost of mining, where diesel consumption accounts for about 15% of cash costs. On the other hand, lower oil prices reduce the price of LNG, and some customers are able to switch from thermal coal consumption to LNG when prices are low. This switching ability is limited, however, by their ability to receive LNG imports and the infrastructure to generate the power from LNG. Our financial services portfolio will be the part of our portfolio which will be the most directly impacted by recent events. The portfolio comprises about 2/3 in listed investment companies, which will have reduced in value broadly in line with the market. The other part of the portfolio are involved in asset management, where funds under management is the key driver to revenue. Lower FUM as a result of market movements and potential redemptions will have an impact on profitability. However, we believe that our investees have resilient business models, and good quality managers who know how to invest through these types of events will ultimately do pretty well. The pharmaceutical portfolio is comprised of investments in API and Apex, which is listed in Malaysia, as well as Pala Pharma. At 31 January, the portfolio was valued at $269 million and generated dividends of $4.6 million through the half. All of these pharmaceutical portfolio companies are doing pretty well in the current environment. The demand for health products produced and sold by Apex and API is very strong at the moment and likely to be resilient in the future. Pain relief medication produced by Pala is also in demand and prices are rising. Offshore revenue of Pala and Apex is also benefiting from the weaker Australian dollar. API and Apex are the majority of the portfolio, and both have outperformed the index since the start of the second half. Round Oak is currently mining 3 operations: the Jaguar mine in Western Australia and Mount Colin and Barbara in Queensland. We're mining a combination of zinc and copper, and we expected copper prices to be a lot higher. However, last year the trade wars impacted prices, and this year prices have again retreated. Both zinc and copper prices have fallen below our expectations, and this is impacting profitability. The situation is not improving in the current environment, but at least the falling Australian dollar is providing some relief. We're also starting to see some falls in the zinc treatment charges, which had risen to very high levels. Mount Colin and Barbara only commenced operations late in 2019, so we're only just starting to see the benefits of those operations coming online. The property portfolio was stable through the half. We have just 3 assets: an industrial site in Castle Hill, which we expected to redevelop in time, an office building in Pennant Hills, and our smallest investment in the portfolio is a property in Penrith, which is primarily retail tenancies, which may come under some pressure as a result of recent events. Our private equity portfolio is comprised of 16 unlisted investments with a total value of $239 million. This portfolio increased as a result of the $110 million new investment in agriculture, which I discussed earlier. We believe that this is an uncorrelated asset class benefiting from the opening up of foreign trade and demand for Australia's good quality produce. Ampcontrol is our second biggest investment and continues to benefit from strong infrastructure, resources and energy project spend. We don't at this time see material impacts on this business. While the majority of the portfolio is currently unaffected by recent events, we will experience short-term impacts on a couple of our smaller investments. Aquatic Achievers is an investment that we thought was quite defensive because even in a recession, children still need to learn how to swim. However, it has been caught up in the current shutdowns and all swim schools are now closed. 7 Miles distributes coffee to cafes, and again we believe that coffee consumption is something that we would have thought would be quite recession-proof. Our experience is that people stop a lot of expenditure before they cut out their morning coffee. But of course the closure of many cafes will have a short-term impact on that business. Our equities portfolio totalled over $600 million at the end of the half. The portfolio is separated into small cap portfolio and a large cap portfolio. The small cap portfolio has around 50 investments and had an outstanding performance through the period, generating over 18%, while the small ords index returned just 2.8%. The large cap portfolio also performed very well through the half. Total return was 6.9%, which beat the index by 1.7%. Thank you very much for your time, and we'll now open it up to questions.